Good afternoon, everyone, and thanks for joining us this afternoon. Trusting you're all keeping well. My name is Vito Dintrono. I'm Yarra Capital Management's Chief Commercial Officer, and I'm delighted to welcome you to this afternoon's webinar with Dion, Hershan, Katie, Hudson, and Joel Fleming, respectively, Australian Equity Portfolio Managers across large, mid, small, and microcaps. Very shortly, the team's going to take us through a presentation that covers the broader Yarra team's key learnings from reporting season and how these themes are translating into decisions at the portfolio level. But before we get started, just a couple of housekeeping items. Firstly, you're listening to this webinar using your computer speaker system by default. All participants are in listen-only mode. Questions can be submitted at any time by typing them into the question panel. The control panel, I should say. Just look for the question mark symbol, and we'll look to address as many questions as we can at the end of today's formal presentation. As always, we aim to wrap up a little after 3:30, but for now, I'd like to hand over to Dion Hershan, who will cover off some of the key market observations from the August reporting period. Thanks, Dion.
Thanks, Vito, and good afternoon, everybody. I thought I'd start by framing what was a very unusual reporting season. Following my comments, Katie Hudson will reflect upon some of the more important themes that emerged from reporting season, and Joel Fleming will put a spotlight on some high conviction stocks in the portfolio. I'll start by saying reporting season is always a frenzy. Hundreds of companies releasing results in a short period of time, and investors jumping on every data point, and on most occasions actually overreacting to short-term news. This year it was clearly different, and I say that not just because all our meetings are via Zoom. But with COVID being a mainstream issue in mid-March in Australia, most companies had already withdrawn guidance. The correction in the market was severe, more than 30% from the highs in February. And frankly, expectations for reporting season in companies probably couldn't have been lower. Unlike the GFC, which in hindsight was a slow bleed, this downturn was more violent, abrupt, and there was no prior cycle which could be used as a reference point. So as distinct from a normal reporting season, the emphasis was not on second half results to the second decimal point, as it often would be. It was more about understanding balance sheets, liquidity, operating restrictions for companies for the foreseeable future, because ultimately that would determine their path forward. It was obvious to us as a team by the second quarter that a recession was imminent, but it was a very different one emanating from a forced curtailment of economic activity. We didn't fixate so much on what letter of the alphabet was best to describe the outlook. It was pretty clear that there was a ton of fiscal and monetary stimulus going into the system, and different companies with different sectors in different regions would perform and exit this cycle vastly differently. So what I'd like to do is share 5 observations from the reporting season. I'll start on page 5. If you would look at the actual results versus consensus, and that's a headline which people often fixate on, the results were probably less meaningful than ever, because if you looked at the headlines, everything was okay. But when you look at the annual results of fiscal 20, it was pretty clear that they consisted for most companies of 3 relatively normal quarters and the final quarter, which was chaos. With respect to COVID, broadly speaking, we classified companies into 4 groupings. There were some short-term beneficiaries of the dislocation from COVID. It's worth thinking there about supermarkets, where there was a massive shift in preference for how people chose to eat and a pull forward of demand. Another grouping was the structural winners, where their businesses and their growth was going to accelerate as a consequence. It's worth thinking about data centers and online retail there. There was also a cohort of companies who were pretty indifferent, that operated independent of what was taking place. It's worth thinking there about mining companies or telcos. And then there was a large cohort of companies which were vastly disrupted. Some of the disruptions were short-term, some were more permanent, and the travel sector is a prime example. The impacts of what was taking place were obviously difficult to assess. I would have never imagined that in the midst of a pandemic, the largest listed funeral operator would have a profit downgrade, and discretionary retailers would be upgrading their results as a consequence of 30% plus like-for-like sales growth. Clearly, there are things we want to be careful in understanding and not quick to extrapolate for long-term implications. With most companies withdrawing guidance in the fourth quarter of the year and often providing interim trading updates at the same time, expectations had been dramatically reset, and in fact, they were desperately low. So by the time we got to reporting season, you could look at the headlines and say 31% of companies beat consensus, 25% missed, which is a pretty normal ratio. But looking at that number in isolation would be misleading. In fact, 30% of companies actually lost money in that time period, which is 4 times the normal level. And 26% of companies, only 26%, saw some form of earnings growth. So all importantly, the conclusion from reporting season was that earnings for fiscal 20 declined by about 15% year over year. It was the weakest year since the GFC, which shouldn't come as a surprise. That was really led by the industrial sector, which was down 14%, albeit those companies continue to positively re-rate and perform well as far as the stocks go. Financial earnings were down 24%, very heavily pressured by the bad debt provisions the banks put in place, not for losses that are incurred, but for what they expect to incur in the future. But the resources sector was obviously strong, holding earnings relatively flat on the back of elevated iron ore prices and gold prices, which are more than enough to offset the weakness in oil prices. But just turning to page 6, when you look at the performance Australian market in August, it was up circa 3%, but I wouldn't read that as being a reflection of the results. In fact, the global market was up about 7% during that time period, and Australia lagged. In the month of August, there was a lot of excitement about a cyclical recovery in global economies, progress being made on vaccines, and ultra-low interest rates. All of these things conspired to cause tech to go up dramatically, and it really has been the powerhouse lifting markets globally and to a lesser extent locally, almost indiscriminately. But the key point of difference when comparing Australia versus other markets is tech is approximately 4% of the ASX 200, it's closer to 30% of the US market. And of course, the Australian market has a much higher reliance on resources companies and banking sectors, which haven't grown at the same rate as tech by comparison. But if you looked at the dissecting the results of reporting season, what was pretty clear was some of the ugliest results were actually some of the best performing companies, which is evidence of the fact that people are starting to chase recovery stories, often quite indiscriminately. In fact, of the 20 best performing companies in the market, the number one in August was corporate travel, up 81%. And 4 of the top 20 companies in terms of performance in the month of August were actually travel businesses. Just turning to page 7, no surprises, but in an environment like this, cash was clearly king. Companies preserved it, and that was evident when we looked at dividends. So approximately 70% of the ASX 200 either cut their dividend or paid no dividend, which by definition is a pretty extreme cut. About 20% increased dividends, but that's probably more in the resources sector, where prices remain high and the lagging performance is still strong. Dividend cuts do undermine the central appeal of equities, because the aggregate yield of the ASX 200 is now well below 4%. But that has to be viewed with a view that some of these changes are probably more temporary than permanent, and we are in an ultra-low interest rate environment. So anything close to 3.5% to 4% by comparison still seems sensible. But when we looked at dividend policies, what was pretty clear was boards are being cautious. For many companies, but not all, the operating performance had been deteriorating. They wanted to strengthen their balance sheets. But in case of the banks, which were up to 30% of the market's total dividends, they had very clear guidance from APRA to either not pay or only pay modest dividends. So from here forward, dividends will continue to be very important. And 2 of the more important factors that will determine the path for dividends in future years is, in fact, the bad debt outlook for banks, which will determine how much capital they have and their willingness and their ability to pay dividends, and also the iron ore prices, which have been causing Rio and BHP to have strong results, and Fortescue, for that matter, had very strong dividends. So what was pretty clear was companies wanted to continue to strengthen their balance sheet. And what also became clear was for some companies, equity was an obvious way to do that. So in addition to reducing dividends, over the last 6 months, we've seen circa 40 companies in the ASX 200 raise approximately $25 billion, in fact, diluting existing shareholders, with some very large raises from the likes of NAB and Sydney airports, up to $3 billion plus. So what I'd point to there is there were businesses that needed to strengthen their balance sheet. They were the minority, not the majority of businesses. And by comparison, although these equity raisings are significant at $25 billion, they need to be viewed in the context of a $2 trillion odd market. And we also need to view them in the context of the GFC. In fact, the equity raisings in this instance were only about a quarter of what was raised during the GFC. So it highlights that although this shock was more sudden, interest rates are lower and balance sheets were dramatically better going into this crisis than the prior crisis. Most of the listed companies we look at today actually have considerable amounts of liquidity and solid balance sheets. But there are some that are going to be overgeared if this recovery is gradual rather than sudden. So we would expect to see a few more capital raisings in Q4 and also in Q1. Just turning to page 8, with respect to the outlook commentary, which is where people are obviously fixated, given the level of uncertainty. What we'd say is very few companies actually offered definitive outlook statements, which is understandable given the level of uncertainty. In fact, only 50% of companies provided some form of guidance, which is a dramatic drop on prior years. So when you look at consensus estimates for forward years, which are obviously informed by the results we've seen and the commentary from companies and the outlooking environment, what you'd say is that consensus estimates suspect that fiscal 21 earnings will be relatively flat with fiscal 20. Recall that fiscal 20 earnings fell by approximately 15%. But there's a number of stories that sit inside that flat number. The consensus numbers speak to a much stronger second half of the year than the first, which is understandable. And it also speaks to quite a dramatic rebound in earnings in fiscal 22, which we think is going to prove probably a little bit too ambitious. In fact, in fiscal 22, there's an expectation that industrial earnings rally by 16%, REITs rally by 13%, financials rally by 19%, which we think is too optimistic, given this recovery will be gradual rather than sudden. So a couple of other interesting points to call out from reporting season is although fiscal 22 earnings still look like a hockey stick, for the next 12 months ahead, consensus estimates didn't change dramatically. In fact, they remain at that flat level I described before. And inside the flat level, you'd see the resources sector was growing by 4.5% according to consensus. Financials are flat and industrials are flat. So as we look at the year ahead and the outlook, there are 3 or 4 swing variables, which as a team we're going to be monitoring very closely because they will inform the aggregate path of ASX 200 earnings. Clearly, there are a lot of different companies, but there are 3 or 4 variables that will probably determine the path forward for aggregate earnings in the year ahead. It'll be the bad debt outlook for banks, given how important banks are at 20%. In this year that just passed, bad debt provisions tripled, and we'd expect them to stabilise from here. There's iron ore prices, which I've touched upon before. They're currently at $130 a tonne, which is about 30% higher than consensus estimates. If they remain at these elevated levels, it would cause quite significant upgrades for the sector and, frankly, the broader market. There's the Australian dollar, where we need to monitor it closely because if it rallies further, that could also cause aggregate earnings downgrades. But the fourth factor is obviously the path of interest rates, which will affect the cost and the ability of companies to fund. From here, it looks very low. We are mindful it's a pretty dynamic environment. So with that, I might hand over to Katie to discuss a number of the other themes that came out of reporting season.
Thanks, Dion, and good afternoon, everyone. Reporting season was certainly different for us this time, and I'm pleased to report that our team navigated difficult circumstances really well. I'm going to build on some of the themes that Dion observed, initially with reference to the small cap market, and I'm going to start on slide 10. So what this highlights is the small cap sector continued the run of outperformance since the market bottomed. It outperformed in August alone by over 500 basis points, which was very strong. It's now up 55% against the ASX 100, which is up 32% since that 23rd of March bottom in the market. As we think about what the key drivers of that small cap outperformance might be, the starting point was actually a wide valuation gap, and so that has provided support. Australia outperforming, both from the health and economic point of view, has certainly been supportive, which for small caps, which tend to be more domestically biased. A rising Australian dollar is typically supportive for small caps. They're typically net importers of the currency, as opposed to large caps, which often have a headwind as the Australian dollar rises, being offshore earners. And certainly when risk is on, as it has been over the last 4 or 5 months, small caps tend to perform quite well as well. What's interesting though is despite this very strong period of outperformance, the relative valuation gap as we've come out of reporting season for small caps still looks relatively compelling. There's a couple of reasons for that. The small cap sector outperformed in an earnings sense through reporting season, and the technology sector, as Dion mentioned, which was a really strong performer over the last 4 or 5 months, and particularly through reporting season, is largely now in the top 100. So all but one of those famous wax stocks are now top 100 performers, and their share price outperformance was driven by a re-rate rather than strong earnings. So that speaks to that relative valuation gap still widening and still looking relatively attractive. In terms of reporting season itself, the largest driver of small cap outperformance was actually the consumer discretionary sector. It was up 23% in August alone. I'm going to talk a bit more about why we think that trend is unsustainable and why it's a really important insight into how the market's operating at the moment shortly. But that was certainly one of the key factors contributing to that relatively strong small cap performance, given that it represents 16% of the small ords and a much smaller proportion, only about 6% of the ASX 200. A couple of other themes, the dividend payers continue to be very strong outperformers. We think that real yield trend will continue to be a compelling theme. We talk about 3% or sustainable 3% dividend yields as being the new 5%, with sustainability being the key word here. Earnings were downgraded by about 3 or 4% for F21, but the wide dispersion in forecast highlights that there is a lot of difficulty in forecasting earnings. As Dion mentioned, the massive reduction in the number of companies providing guidance is also a factor. A number of people have asked us how we navigate this environment with obviously a lot of reduction in short-term guidance, very low visibility on operating trends and increased volatility. So what we continue to do, as we have right through this crisis, is continue to ask ourselves whether the long-term earnings power of a business has changed. In some cases, the answer is yes, and it's accelerated trends and created shifts. In other cases, the answer is no, and that's speaking to a really interesting opportunity. Just turning to slide 11, I just want to talk a bit about the consumer discretionary sector. As I mentioned, it's a really important driver of performance in reporting season, but it's also an important example of market behaviour at the moment. As I mentioned, it was very strong. It drove very strong outperformance, particularly for the small cap sector. I've been calling it buy July, and the reason for that is investors have essentially bought the very strong July trading updates from the retailers. And it's important to reflect on my earlier comment to understand whether this has signalled a shift in earnings power of these businesses. On the chart on page 11, you can see that we've set out the F19 and F20 like-for-like sales trends for the listed retailers. On average, they've traded between about 4 and 6%. So sales trends for the retailers historically has been around that sort of 4 to 6% level. For F20, that flowed through to net profit growth of about 8%. And importantly, as we sort of unpack those numbers, we can see that the government subsidies actually drove almost 100% of that earnings growth. When you add in rent subsidies that a number of the retailers received, that actually spoke to anywhere between 5 and 19% of EBIT for the listed retailers. So a really important contribution. And then as we look at the more recent trends, the like-for-like trends for July and early August, which the companies have just reported, so often that 6-week trend post-balance date, on average, the listed retailers reported 34% like-for-like sales growth, which is massive. On the back of that trend, analysts have upgraded their forecast to have, for F21 NPAT growth, consensus estimates of about 29%. And on the back of those large upgrades, the PE multiples have expanded by about 26%. So we've had big early like-for-like trends that are very strong, big upgrades and big re-rates of those stocks. So what's happening here, and do we think it's sustainable? This trading update window really coincided with that sort of June, early August period, which was that trading post-lockdown. So a combination of pent-up demand, higher discretionary income for those of us who still have jobs. Think of it as not spending money on car parks, not spending money on childcare or expensive lunches in the city. Means for those of us who still have jobs, we've got higher discretionary income at the moment. And money flowing from JobKeeper and early super are also flowing into retailers. For those of you who are on the call who are representing super funds, you'll be very disappointed to know that motorcycle sales surged in that period, and early access to super was often cited as a source of funds for that purchase. So the key question for us, once again, is has the earnings power of the sector changed? In some cases, we think there's been some support. Listed companies are certainly more exposed to the home and office environment sales activity. So I think Bunnings, JB Hi-Fi, Adairs, Nick Scali. There's also a shift to online, which is certainly accelerated. We think that's permanent, but often that's at the expense, particularly for some of those retailers who are listed at the expense of store sales. So we need to be careful to extrapolate it. The other interesting trend was large retailers have taken share from smaller players. We think that reflects the larger players' ability in the online space, and to some extent that will also be permanent. On the other side of the ledger, some of those trends such as housing spend, home office spend will prove to be temporary. And a great example of that is a company like Harvey Norman reporting like-for-like sales of 40% after 8 consecutive quarters of almost no growth whatsoever, does speak to some activity that will prove to be hard to cycle and certainly not persist. As we think about going forward into F21, that discretionary income activity is likely to moderate. We'll return hopefully to normal spending patterns, and that sales period will be hard to cycle. And of course, the subsidies and the rent abatement will also prove to be will certainly prove to be non-recurring. So arguably at a time of peak sales and peak earnings, investors have re-rated retailers to be growth businesses. And it's one example, but there are many of trends that we're seeing where investors are extrapolating what will prove to be temporary events. We're underweight the retail sector today in the small cap portfolio, and we think it's another example of where this sort of short-termism is creating significant opportunities for investors with a long-term mindset. And before I hand over to Joel, I'm just going to, on page 12 and then page 13, just talk about 6 other trends that we saw in reporting season. The first one is cash flows were actually very strong, and in fact balance sheets were better than expected, but we would argue that's artificial and will be hard to sustain. Working capital was managed down in some cases because of reduced revenue. In some cases, listed companies pushed inventory back to their suppliers, and we saw also the benefit of a number of companies delaying payments such as tax and government subsidies, which allowed them to improve, at least temporarily, the appearance of their cash flow. Cash flow is usually the source of truth for us in reporting season, but wasn't so much this time. And we had to be very careful as we navigated, as I said, what appeared to be artificially inflated cash flow and balance sheet positions. Management does appear to have recognised this issue, however. As Dion mentioned, dividends were cut, but they were cut at the rate of 2 times earnings. So effectively, management are recognising that the sustainability of their balance sheet positions and the cash flow will not persist. As these effects fade, we may see the need for more balance sheet repair and capital raisings, and it's certainly something we're watching closely. The second point there is around the consumer versus the corporate customers. And so I've talked a bit about the rebound in consumer spending, which was strong and was in really stark contrast to corporate spending, which was still muted. So if you're a company that had a corporate as your customer, so think media, IT services, construction, then certainly weak demand was on display as corporate customers are being slower to rebuild their confidence and slower to rebuild spending. So an interesting question for us is it corporates have just been slower to rebound, or a better lead indicator of the economy than the consumer, which has obviously rebounded very strongly? The third point that I wanted to call out is about write-downs. We often talk about not wasting a crisis. Well, certainly companies didn't waste a tough year to clean up their balance sheets. There was over $28 billion of asset write-downs and provisions, which was equivalent to about 85% of the underlying earnings for the ASX 200, so a pretty big number. There was a raft of activity on this front: inventory write-downs, software write-off, rebate write-offs, and tangible impairments. The whole media sector pretty much wrote off a number of their assets. In some cases, that was appropriate, given sectors like the media sector, there has been some evidence of acceleration in the structural trends that were already underway, and so write-offs in that case may be appropriate. But in a number of other cases, we think this may prove to be overly aggressive. And as we saw post the GFC, there can be occasion where this sets up future profits with lower depreciation and provision write-backs supporting earnings going forward. Outside the banks, as Dion mentioned, there's also been a lot of provisions for receivables from energy retailers, construction, waste management, credit collection companies, insurance brokers, all taking provisions against debt recovery, despite the fact that no stress is yet evident. In some cases, these are big numbers, and we're going to be watching very closely for evidence of write-backs because, as I said, they can certainly prove to prop up future earnings. And just on page 13, just to finish off, a couple of other important reporting season themes that we observed. Cost inflation emerging as a key challenge in the resources sector. This will be particularly relevant for the domestic producers where labour movement has been exacerbated by border closures. So WA, for example, is usually an importer of labour. We know that a number of companies are trying to undertake some creative solutions to overcome this. But there is some early evidence that wage inflation is starting to creep in, and that will certainly speak to, despite high commodity prices, the risk of peak margins in the resources sector. The fifth point is around REIT valuations, which have started to contract. And what we've seen, particularly in select office and retail sectors, is an important inflection point for valuations. The decline in cap rates, which had been offsetting the deterioration in operating fundamentals, is no longer enough. And while balance sheets look okay, that can change very quickly when valuations start to reverse, and that's something that we're monitoring very carefully. And finally, from my perspective, this focus on short-term trends, which had already been a feature of the market pre-COVID, I think is absolutely amplified and is now at an extreme level. The volatility in operating trends, the difficulty in forecasting short-term earnings, the market's enthusiasm for extrapolating that last data point, from our perspective, is amplifying the opportunity for investors willing to act on that long-term mindset. And from our perspective, it's certainly creating a great market environment to set up portfolios for long-term outperformance. And we're actually enjoying the opportunities the market's throwing up for us at the moment. On that, I might hand over to Joel, who's going to talk about how he's doing just that.
Thank you, Katie, and good afternoon, everybody. Today, I thought I'd focus on two stocks in our microcap fund, well placed to benefit from COVID-related changes to the market. These sit outside the obvious recent share price winners, such as the e-commerce players or buy now, pay later space, which have seen significant valuation increases. We start on slide 15. The first stock is Alliance Aviation with a market cap of $550 million. This is a top 3 position for the fund, and while seeming counterintuitive given the current state of the global aviation market, it's been a long-term holding, and structural shifts occurring in the market mean they're very well placed to become a much larger business over the medium term. When we look at this business, it predominantly supports the fly-in, fly-out mining industry, which has kept going through these COVID-related times. It's on a long-term contracted revenue base, and they take no risks around fuel or passenger load. And they really help to keep the mining industry operating during this environment in terms of social distancing on aircraft, temperature checks and processes around getting people to and from site. And we're a real key component of that process. What has really pleased us at the start of COVID, with all those jets parked down and aviation networks coming to a halt, across the world, they've proven a resilient business model. And that's really important to us. A strong management team with a clear focus on their key end markets has really come to the fore during this period. What we like about the opportunity for Alliance is the domestic aviation market has changed. With Virgin entering voluntary administration, there is an opportunity for Alliance to grow significantly and support customers who used to rely on the domestic aviation network to get to their sites, get to their places of work. There's a real opportunity for them to build out a long-term contracted base from which to operate. When we look at the COVID-19 impact, they reported a record full-year profit, which goes to the durability of the business. They received no JobKeeper payments and only $2 million as part of the government's aviation assistance plan. As I said, they're a key supplier to the mining industry, and in this time, they've been a beneficiary of significant charter work. So when you think about how the NRL teams move around to allow the season to take place, they use Alliance. There is significant need in this time for people to actually move within states and even between states. And Alliance have been an operator who've stepped up and provided that services to key clients. The competitive landscape has changed dramatically, and some of the relationships that are being formed during this period, by allowing companies continuing to operate as they move their staff around safely, provides the opportunity for Alliance to turn these into long-term and structured contracts. They recently raised capital to support growth by buying some new aircraft to add to their fleet. You could imagine it's a pretty good time to be buying aircraft, and with the availability of pilots and cabin crew at this point in time, they are really well positioned to take full advantage of the opportunity that exists. We have been a shareholder for a long time and certainly didn't predict the structural changes that would occur through COVID, but really point to this stock as being someone in what at a headline would appear to be a very tough industry to operate in, to be at a point where they can take full advantage and become a key part of that domestic aviation network in Australia. Flipping over to the next slide, slide 16, the next stock I'd like to talk about is Pacific Smiles, $280 million market cap, and it provides dental centres and all the infrastructure and services required for a dentist to be able to focus on dentistry. We had begun to build a position pre-COVID on the progress being made by the new management team in improving returns in their existing network. Of course, when COVID hit, any kind of elective surgery or a trip to the dentist was off the table. We had closures of centres except for emergency operations, and it was a business model that was sold down significantly. It's one of those examples of a service in which demand is just pushed out. It doesn't disappear. People still need to look after their teeth and go to qualified professionals to undertake that process. This business operates 94 dental centres across New South Wales, ACT, Queensland and Victoria, and very importantly is a rollout model, not roll up. Doesn't acquire other operators and try to arbitrage a private to public multiple. They were one of the few companies to provide forward guidance for FY21, and there's clear evidence of the turnaround strategy progressing well despite the COVID-19 impact. They continue to invest for growth, and we think that COVID will mean systems, processes and scale will become a significant benefit for these larger corporatized offerings. A standalone dentist will be operating in a much tougher environment post-COVID for these reasons. There are positive industry dynamics and scale benefits increasing in a fragmented market, likely long-lasting impacts of COVID, where we see an operator like Pacific Smiles well placed to benefit. And again, to Katie's point on capitalising short-term demand numbers, it was pleasing to see the year-to-date growth in same-centre patient fees. We've seen the backlog roll through and move to a more new normal operating environment, and organic growth remains very solid, which is pleasing to see. And while they were eligible for JobKeeper, the forced closures of their centres, again, has been offset by that build-up in demand, which has been working through the system. Key catalysts for a business like this, health fund agreements. They've successfully executed an agreement with HBF in WA, which is a market which they don't operate in currently. And health funds are seeking to offer great services for their members. And this allows Pacific Smiles to work with a really credible partner in a new market, and a successful relationship in this under this partnership offers a lot of potential for the group. The other thing is it has a large rollout opportunity. Currently, they have 94 sites. Looking at demographics and opportunities throughout Australia, there is potential for them to reach 250 sites in time. And we should be able to see continued operating leverage as they run their centres more profitably, more efficiently, and offer a great service to their customers. And furthermore, with the COVID-related issues, we see continued upside through industry consolidation. Private equity have recently participated in buying out some listed peers, and we see that continued industry consolidation being a key theme for a stock like Pacific Smiles. With that, I might hand back to Vito to wrap up.
Great, thanks, Joel. We've still got time to tackle some questions, and quite a number have come through. So thank you for those that have submitted questions. For those that haven't, there is still time to do so. So please feel free to send them through. Dion, we might commence with you. The first question is, can you provide some examples of where you've seen opportunities as a result of companies over-earning as a result of the pull forward in sales?
Yeah, thanks, Vito. I'd say where we're seeing companies over-earning, and given we are long-term investors, we're tending to avoid those companies. We want to be careful not to extrapolate strength in short-term trading. And Katie mentioned furniture companies and some retailers comping at 40%. We think that's going to be short-lived, and if anything, it creates a hole in the future as consumption has actually been pulled forward. One opportunity that probably came from the confusion around that topic is actually Sonic Healthcare, where a lot of people thought Sonic would be a massive beneficiary of COVID testing, which is true, but in fact their non-COVID testing slumped because GP visits were less frequent and elective surgery was postponed or cancelled. So in terms of Sonic, on balance, there's some short-term strength, but in the medium term, we actually think the environment will improve because as COVID tests subside, all the other non-COVID testing will resume, and that'll more than fill the gap. So that'll be an opportunity that came from the confusion, but we are very careful to avoid companies that just might have their moment in the sun now and things will mean revert in the future.
Great, thank you. Katie, one for you. What's your view on the outlook for healthcare stocks? Companies like FPH and NAN have held up pretty firmly since March. Do you expect they can deliver on expectations on a 1 to 2 year view?
Thanks, Vito. So Fisher & Paykel and Nanosonics are both really interesting contrasts in how COVID has affected their businesses. Fisher & Paykel Healthcare has actually seen a short-term acceleration in the adoption of their respiratory therapy in hospitals, and that's actually created an acceleration of a big adoption process they're undertaking, which has brought forward activity. We don't think that's a one-off. We think that will persist. They have a very, very high level of recurring income and consumables attached to their business. So once they're in the hospital and continue to use, they continue to generate revenue. So yes, we think they'll continue to hit numbers, if not upgrade over time. Nanosonics is a contrast in that there has been some short-term disruption to their adoption curve because they can't get access to hospitals. And while the demand is still there, we think it has been deferred, not lost. So while that may be a short-term disruption, we think that opportunity will continue to be there, maybe just shift to the right slightly. And over the next sort of 2, 3, 4 years, that their global adoption of their product, which is only at circa sort of 15 to 20%, will continue over that period of time.
Thanks, Katie. Another one directed your way. Given the quantum of write-downs you've mentioned, how have you got comfort around where and when those write-backs might come? And it doesn't sound like it could be a powerful theme within the small cap realm.
Yeah, thanks, Vito. Yes, write-downs certainly tell a story. And so while they're typically one-off and while they don't have cash attached to them, often, we do spend quite a bit of time trying to understand what that story is trying to tell us. In some cases, it may be a sign or a red flag that accounting has historically been overly aggressive, and that's important. It may be a sign that that the company is setting up future profits to advantage in the future, or it may be that those write-offs are appropriate. So, it's certainly something that we spend quite a bit of time trying to understand what the circumstances are, because, as I said, it does tell us a lot about a company, and it may be an indicator of how profits may emerge going forward.
Great, thank you. And Joel, one coming your way. Are you seeing much in the way of pre-IPO marketing? Do you expect to see the quality opportunities in the next 12 months?
The pipeline's certainly filling up and actually looks as robust in terms of number that it has for quite some time. Particularly in the microcap space, IPOs are a constant theme. But what's interesting this time is we're starting to see some of those larger opportunities build in the pipeline. We are very selective, and one of the things about IPOs, they tend to come along at a time of mass enthusiasm for particular sectors. So we wouldn't be surprised to see the buy now, pay later space, e-commerce, cybersecurity, these key kind of trends of the moment dominating some of those pipelines. And for us, as always, we look at the company closely. We want to understand the history, how long that they've been in business for, and gain some real conviction that this is a good business that could drive some strong returns for our investors. So I think that there'll be a lot of things to look at, certainly. But again, we're very selective in the way that we approach it.
Right, thanks, Joel. We seem to have struck a chord with this topic, and there are a number of questions in the queue. That said, I'm very mindful that we're nearing our allocated time, so we might call it there for today. That said, the questions that are in the queue, we'll look to get back to you in upcoming days with a response and a phone call. So looking forward to doing that. I'll also draw your attention to an invitation that you'll be receiving in the next week or so for our next webinar, which will occur in 2 weeks' time, featuring a portfolio manager interview with a portfolio company CEO. So looking forward to delivering that. With regards to today's session, if there are any questions on the back of it, please feel free to contact myself, Mick Green, or Amal Hakopian in the first instance. More than happy to assist, or if not, arrange a follow-up meeting with the relevant portfolio manager. Leaving today, you'll also receive a survey. Feel free to provide input, feedback, greatly appreciated, and really does help us shape the future direction of these sessions that we intend to do going forward. And then finally, on behalf of Yarra Capital Management, a massive thank you for joining us today, for your ongoing commitment, your ongoing support. It is greatly appreciated, and have a great afternoon. Thanks very much. Bye-bye.